Well, welcome to our 2024 Year-End Planning Opportunities webinar. We have a very exciting information-packed webinar today. And if you could please grab a pen, grab a paper. We're going to go through this information in great detail. As always, we do record the presentation. We will be sending you a replay sometime next week, and it will have all the information as well as the slides. Grab a pen and paper, take notes, ask questions. If you do have a question, at the bottom of the screen, you're going to see an icon, Q&A. Please type in your question while you're thinking about it, while it's top of mind. And at the end of the program, we're going to cover Q&A, and hopefully we can get to everybody's question. As we look at the program, we have to always report the important disclosure information. And let's take a look at our agenda as we move to our conversation. So these will be the main topics here today. We're going to discuss year-end planning for 2024, but also very important tax changes coming into 2025 and beyond. A topic that is very much on most people's minds, what's going to happen with interest rates going forward. And we can't forget about the election and an update on the economy. We will go into those details as well, investment opportunities, and then very important reminders at the end. Stay with us the whole time. You won't want to miss any of it. Great info. And on that note, I'm going to turn the program over to Sam.
All right. Thank you for that introduction. And we're here today to talk about planning opportunities. And the main focus of the presentation today is regarding tax strategies for this year as well as next year. So let's jump right in. But before we get into some of the strategies specifically, we wanted to refresh everyone's memory on what the required minimum distribution ages look like, because they've changed a couple times over the past couple years. So what a required minimum distribution is when you have a pre-tax retirement account, so like a traditional IRA, the government requires that you take some money out of it every single year once you reach a given age. So if you were born between 1951 and 1959, the age upon which you must start taking money out of a traditional IRA is 73. If you were born 1960 or later, it is 75. And this applies to most folks on the call here today. And these ages are going to be very important when we talk about some strategies over the next couple of pages. But just wanted to remind everyone so you could see exactly where you fall in terms of when you must start take money out of a IRA. So now let's jump into some tax strategies that we want you to take advantage of. The top one is maxing out retirement plans. So whether it's a 401k, IRA, if you have the ability to contribute to a Roth IRA, simple IRA, SEP IRA, 403b, there's many names to these, but really when you are able to contribute to a retirement plan, particularly when you contribute to it on a pre-tax basis, it helps you in a couple different ways. One, of course, you're saving towards your retirement. And two, when you're contributing money pre-tax to a retirement plan, it's helping you on taxes as well. And so there's many great benefits to doing that. And it's a very simple, great strategy to be taking advantage of. The next item here is tax loss harvesting. This is something that we are doing for you behind the scenes, but wanted to reinforce that we're taking a look at this regularly for you and providing some value. But first, let me explain what it actually is. When we buy an investment and we want to sell the investment, if it's gone up over the course of the year, it will have a capital gain. When you buy an investment and it goes down over the course of the year and you sell it, that is a capital loss. So you are able to net out your gains versus your losses. So if we've been making reallocation decisions and we've sold some investments that have generated a gain, we'll try and identify opportunities, if any exist, where we can realize some of these losses to net out that tax impact for you. And this process is the tax loss harvesting. And so it's an important balance that we try and marry between navigating the portfolio performance overall and also limiting taxes as best we can. But this is something, again, we're doing behind the scenes for you and just wanted to reinforce that this is, a good tax strategy. The third item here is tax smart distributions from inherited IRAs. And we are going to get into this over the next couple slides, but wanted to bring it to your attention now because it is extremely important and one thing that we want to strategically plan for going forward. A fourth strategy is a Roth IRA conversion. I'm also going to get more in depth on this over the next couple slides, but this is another strategy which we should be talking about with almost everyone for this year and next year. Now, it does not make sense for every person, but a Roth IRA conversion should at least be analyzed on whether or not it's going to make sense. The fourth item is a Roth IRA contribution. So if you are a married couple and your modified adjusted gross income is 230,000 or less, you have the ability to contribute to a Roth IRA as long as one of the spouses is still working. So this could be a great opportunity to add to one or both spouses' Roth IRAs to try and get some money in there on an after-tax basis. The fifth item is a qualified charitable distribution. The acronym is QCD. If you are over the age of 70 and a half and donating to charity, this is the single greatest way for you to accomplish the goal of donating to a charity as well as reducing your taxes. So if this applies to you, you're over 70 and a half and you're charitably inclined, let's talk and make sure that we're taking advantage of this strategy. Again, this is one that's very straightforward, but it has such a big impact when it comes to taxes. The last item refers to a health savings account or an HSA. Now, contributing to the HSA is a beautiful vehicle because we like to call it a triple threat. When you contribute to the HSA, it goes in pre-tax. The money is allowed to grow and be invested, and it grows tax deferred. And then when it comes out for a qualified health expense, it comes out completely tax-free. So yes, you did hear that correctly. The money is not taxed at any point in the entire life cycle between your contribution to growth or when it's withdrawn, as long as you follow those three simple protocols. As long as it comes out for a qualified medical expense, then an HSA is something that would be really great to look into if your employer offers it as an option. So now let's spend a couple minutes talking about inherited retirement accounts. So if you have inherited a 401k, 403b, IRA, Roth IRA, this is what we're talking about. So beginning in 2020, non-spouse beneficiaries are subject to what's called a 10-year rule on the retirement accounts. What that means is you must withdraw the entire balance within that retirement account within 10 years after the year of the original owner's death. Now, there's a new wrinkle that was just proposed or clarification that the IRS gave us this year. And what they told us is that starting next year, if you are the owner of an inherited IRA, but the original owner of that account was taking RMDs when they passed, you are also required to take an annual RMD in addition to the 10-year rule. So let me say that again. If the person you inherited the account from was taking annual RMDs when they passed, you must also continue to take annual RMDs and make sure the entire account is distributed within 10 years. So it's extremely important for us to get out ahead of it, particularly when you've inherited a pretty sizable IRA, because the last thing we want to do is wait until year 10 and we have a huge chunk that we need to end up distributing and it pushes you up one, two, maybe three tax brackets when that might be unnecessary because we could spread it out over the course of a couple years. So this is something that we really want to take a look at and analyze depending on your individual situation. So please come in, meet with us, and we'll refine the strategy as necessary. But there are some exceptions to the 10-year rule, and they apply to all the following. If you're inheriting the account and you're a minor, disabled, chronically ill, anyone not more than 10 years younger than the original owner. So, for example, if you received the account and you inherit it from your brother who is 5 years older than you, this would apply to you, spouses, and certain trusts. If any of these situations apply to you, please talk to us, but we wanted to make you aware that there are some exceptions to this 10-year rule. So now let's talk about some upcoming tax changes for 2025 and beyond. When participants reach age 50, they are able to do what's called a catch-up contribution. So I'll use a 401k as an example. With a 401k for 2024, all participants, regardless of their age, are able to contribute 23,000. When you are over age 50, you are also able to contribute an additional 7,500, which is a catch-up contribution. So if you are over age 50 this year, you are able to contribute 30,500. Beginning next year, if you are turning 60, 61, 62, or 63, you are going to be able to contribute an additional amount beyond that catch-up contribution. Now, don't ask me why Congress gave this ability only for these four specific ages. I'm not sure if they had a really great rhyme or reason to it, but if you are turning 60, 61, 62, or 63 next year, you're going to have the ability to save even more than everyone else that's in that over 50 bucket. So let's talk and see if it makes sense to add an additional amount. Another big change to be aware of, and this is happening in 2026, is that the income tax brackets are going to revert to their higher levels. A tax term that is often used is sunset. So what that means is the tax cuts that were put in place after 2017 are ending at the end of 2025, which means that unless Congress gets together and agrees, they must agree to extend the tax cuts if it is going to take place for 2026 and beyond. Given that this is most likely going to involve some bipartisan compromise, our base case at this moment is that tax rates are going to go up. So with the idea that tax rates are going to go up, we want to take a look at how we can do some tax bracket management now in 2024 and 2025 for that reality. Another big change happening in 2026 will be the estate tax exclusion as well. That had significantly increased when the Tax Cuts and Jobs Act was passed. So if you have a estate that's $13 million or less and you are to pass away, in most circumstances, there's going to be little to zero tax. But beginning in 2026, that estate tax exclusion is going to revert back to the $5 to $6 million range. So that's going to impact a heck of a lot more people. So you want to be very aware of how this might impact your estate and your heirs. An option that actually went into effect this year, and just wanted to remind everyone that there are some changes that are still new. One is a new post-death option for surviving spouses. I don't want to get too in depth into this strategy on the call here today, but of course, if this situation applies to you, please schedule a meeting and we will help walk you through all of the options. And the last tax change that just went into effect, but wanted to bring it to everyone's attention again, is you are able to roll over money from a 529 to a Roth IRA. That just went into effect in 2024. There are many hoops that you have to jump through in order to make this happen, but wanted to bring it to everyone's attention just to jog your memory, in case you do have money that's left over in a 529 that is no longer going to be used for education, let's talk about this and see if this is something that we can take advantage of. The updated COLA amount for Social Security for 2025 is going to be 2.5%. And what COLA stands for is cost of living adjustment. So this is supposed to be tied to what the inflation rate looks like and kind of sort of, but everyone who's currently receiving Social Security will see a bump in January. But even if you're not receiving Social Security, as long as you are eligible and over age 62, you will see this estimated on your benefit estimate statements. Another update for 2025 is Medicare Part B premiums. Now, the amount that you pay in Medicare Part B and Part D depends on the income that you report to the IRS 2 years prior. They do a 2 year look back. So you're probably wondering, hey, why did these guys put 2023 next to these income brackets? That's the reason. What happens is Medicare gets their reporting from the IRS and they look at the tax return that you reported 2 years ago in order to determine what your premium is going to be. The tax brackets moved up slightly, as well as the premiums on both B and D. I want to get into a Roth IRA conversion strategy with you, but I want to make sure that we're all on the same page and understanding the dynamics of what a traditional IRA is versus a Roth IRA. So let's start here on the left-hand side with the IRA column. When money is contributed to an IRA, it is done pre-tax. The assets in the IRA grow tax deferred, and when you take a withdrawal, it is fully taxable. The Roth is almost the exact opposite. We contribute money after tax, the assets grow tax deferred, and the withdrawals, when they come out of a Roth IRA, are tax-free. They're all completely tax-free when you're over 59 and a half and have had the account open for 5 years. So you just think about it, when you're in retirement, they're going to be coming out tax-free. So now let's talk about a Roth IRA conversion. Now, the goal of doing a Roth IRA conversion, which is where you move money from a traditional IRA to a Roth IRA, the goal is ultimately to pay lower taxes when we're withdrawing money from the IRA. As we talked about a couple slides ago, the government is going to require that you take money from an IRA once you reach your required minimum distribution age. So they are going to force you to take money out. So instead of waiting until we are forced, instead, might there be a better time for us to take it on our own schedule? And given that the tax brackets are going to increase in 2026, we might be able to take these distributions at lower tax rates in 2024 and 2025. So if you are going to retire over the course of the year, if you have just retired, if you think that your income is going to substantially increase over the next couple years, if you are between jobs, if you just got let go or you quit work or you have a significant change in income, either way, increase or decrease, let's analyze and see if this is going to be a good strategy for you. And another thing that we need to evaluate as well is when you're contributing to your retirement plan, are we doing it pre-tax or are we doing it Roth? That's another component that we want to make sure that we're analyzing. But in summary, a Roth IRA conversion, particularly for 24 and 25, is something that we should strongly consider and at least analyze to see if it's going to be the best option. Let's switch gears entirely and talk about what's happening with interest rates and what we can expect going forward. The Federal Reserve met last month and they decided to lower interest rates by 0.5%, which is what we can see here on the right-hand side. And what we're looking at ultimately with this chart is what's called the federal funds rate. And at the meeting, the Federal Reserve had indicated that they're probably going to lower interest rates by 0.25% at their November meeting, as well as their December meeting. They've also indicated that they plan to lower interest rates a couple times throughout 2025 as well. So you can see interest rates have gone up very significantly since 2022 when the Federal Reserve was trying to get a handle on inflation. Inflation has been trending in the right direction. And so that's why the Federal Reserve feels more confident that they can begin decreasing interest rates without causing a further spike there. The second reason why the Federal Reserve is also trying to lower interest rates is they want to reignite some growth when it comes to the economy. We've gotten a couple softer jobs reports than I think the market and the Federal Reserve were expecting. So by decreasing interest rates, they want to make it less burdensome for companies to invest in their workers, to invest in inventory, to invest in other capital expenditures. They also want to make it less costly for you to buy a car if you're taking out a loan. Your credit card interest rates are going to go down. Mortgage rates might potentially go down, and we'll, I think, be addressing that here at some point. But uh, in terms of where we see interest rates, the markets dictated a lot of things over the last couple of years in terms of their direction. In terms of how much they end up going down, the market is anticipating about 1.5% by this time, by the end of next year. We'll ultimately see how far we go. But at this point, we do think that, at least with the federal funds rate, it'll probably be lower than it is today. Let's spend some time talking about the economy as well as the election. What we're looking at here is a chart which shows real GDP growth from the early 2000s up until present day. And the light blue dotted line shows what's called the trend growth. So just smoothing out the growth over this long period of time. And roughly it's showing about 2.1%. And we believe that this trend should continue. We do not think we are in a recession. We do not see one on the immediate horizon. And quite frankly, one isn't really on our radar at the moment in terms of being something that we think is a big risk. And with the Federal Reserve lowering interest rates or indicating that they will, we think that's also a bit of a tailwind to help provide a little bit more of a boost to keep the economy going forward. And so we've seen great performance the last couple of years, and we do think that this trend is going to continue. Switching gears entirely and talking about politics, we are data driven in everything that we do. So we wanted to show you one of the many charts which back up our investment process and our philosophy when it comes to navigating the stock market around different election time periods. And the moral of the story with this chart is that long-term investors are rewarded under Republican presidents as well as Democrat presidents. You can see many examples of each. And the moral of the story, as you go from left to right, is that under both parties, the market finds a way to be resilient. Presidents often receive way too much credit when the stock market is going well. And as sad as this is for me to report, they also receive too much blame when things go poorly as well. It's our job to remove the political bias with the investment process and stay true to the fundamentals. And the fundamentals and the research is very clear in our mind, which is we need to make sure that companies are continuing to grow their profits and to be successful and not try and get too deep into politics. So let's talk about some investment opportunities. But before we do, one question we're asked quite frequently, given all of the geopolitical news and conflicts going on, is how does war impact the stock market? Are you worried? Are we making any changes? What should we be aware of? This chart, sadly, shows a lot of different data points on when the world has been at war over the last 100-ish years. And you can see when you smooth it out over a longer time period, the market generally tends to go up. And if we were to isolate the wars and conflicts that the United States is more directly involved in, during each time period, the stock market has actually gone up. Now, I'm not suggesting that war is good for the stock market, but the inverse of that statement is also true that when we go into war, it's not necessarily a bad thing either. With each new conflict, they present their own complex situation. So if we were to get into a more direct conflict with China, who's a major trading partner of the United States, who knows what that might ultimately entail. But in terms of the current wars going on in Ukraine as well as in the Middle East, right now, we don't think it has too big of an impact on your portfolio or how we're thinking about the investments. Another question which is asked quite frequently is, I see that the market's at new highs or close to new highs. Are you sure now is a good time to invest, or should we wait until there's a correction? So we wanted to go into the data and try and determine, is investing at a new high a bad idea, or is it really, on the opposite token, a good idea? And what we found is actually that when you invest at a new high, your future returns are actually expected to be higher. So what we're looking at is two different bar charts here. The gray bar charts show if you invested money on any given day. The green bar chart means that you had invested money once the market hit a new high. And as we look on the right-hand side of the chart over the 3-year and the 5-year time frame, we can see that your investment returns are actually higher when you invest new money every single time that the market has hit a new high. So just because it hits a new high is not a reason to be worried about there being an impending crash. What's more important is to try and analyze, are companies' earnings sustainable and are they trending in the right direction? And at least based on what we've seen for the earnings reports of the third quarter, we're very optimistic about the direction of earnings and profits for companies, which gives us reason to believe that at this moment, the S&P 500 appears to be, fairly valued in terms of where we're at and justified. So how have stocks done when the Federal Reserve has cut interest rates? On the left-hand side, this shows us how stocks have performed when there is no recession after a Federal Reserve rate cut. And we can see that the average return over the last 60-ish years is 18.5% for stocks. Now, mind you, if you go back to 1926 on the S&P 500, the long-term average is about 10%. So when the Federal Reserve cuts interest rates and there's no recession over the next 12 months, stocks perform roughly about double what they do on average. On the right-hand side, this shows us the performance when the Federal Reserve cuts interest rates, but there is a recession over the next 12 months. And we can see that stocks in this scenario are actually down. It is our case that we're probably going to fall into the no recession bucket, given that we don't think one is currently underway and we don't see one on the horizon. This is another chart which shows the historical significance of both bull and bear markets. A bull market is when the market is going up, and a bear market is when the market is going down. So if we look at the blue mountains on the top, which are the up markets, we can see that they are longer and they are stronger than the bear markets, which are the orange on the bottom, which are much less of a magnitude, and they last for a very short period of time. Now, where we're at currently is this far right-hand side of the screen there. And the current bull market, the current up market, just reached its 2-year anniversary this month. And so on average, if you were to look at all these different time periods, the average bull market lasts about 5 years. So statistically speaking, there's a lot more room to run, but we're more focused on the fundamentals. And right now, the fundamentals are telling us that companies are still moving in the right direction as well. So just because we've had a nice run over the last 2 years, when you look at it from a historical standpoint, by no means do we think that we're near the end. In fact, we might just be near the beginning. But if you want money to remain more conservative than investing in the stock market, which can be volatile, and you have money in your bank account, we have an idea for you to get that money working better for you than just sitting in a regular checking or a savings account. And that idea is the United States Treasury bill, which is referred to as a T-bill. Now, a T-bill is considered the safest investment in the entire world because it is backed by the full faith and credit of the United States government. The interest rates that you see here once you buy one are fixed, which means they do not change over that relative time period, and they're tax advantaged. So the interest that you earn on a treasury bill is only taxable on your federal income taxes, meaning you do not pay state or local income taxes, which is a very big difference from the interest that you pay on a CD, a money market, or just a regular savings account. Whereas in a CD, you're taxed at federal, state, and local. And the last point here, I think, is, maybe just the cherry on top, which is that if you need the money before it matures, there is zero penalty. So let's say we bought a 12-month treasury bill and you need it in 6 months. We sell it and you get the value that it is on that day, no issues. If you were to do the same thing with a CD, then the bank is going to penalize you 3 to 4 months interest. So these are extremely safe, they are liquid, and they're tax advantaged. So if you have money that is just sitting in the bank that you don't want to get invested in the stock market, this is a really great alternative to consider. So now I'll turn it back over to Jordan to talk about some important annual reminders.
Okay, thank you very much. As we always recommend, scheduling a review consultation. If it's been a while, please call the office. We can meet in person, we can have a phone call or a Zoom call. But it is important. There's some year-end planning opportunities that may benefit you. The next item is review beneficiaries. Very important, making sure that every account with us or outside is current, up to date, and it's exactly as you want it. That's something we've discovered over the years where there can be missing beneficiaries or different situations where it does require a review. With regard to tax strategies, Sam touched on these. I'm just going to remind you that taxes are changing. We have a short window to do some planning. You have 24, whatever's remaining, and 25. Let's see if we can't consider some of these options discussed. The second item, tax smart distributions from an inherited IRA. There are strategies in which to go about that in a smart fashion. And then this last item here, if you want to consider a Roth IRA conversion and the QCD, which is the qualified charitable distribution, please let us know. This way we can help get that process in a short time frame that we have remaining. If you let us know by, say, the end of November or at the very latest, the beginning of December, that way we can assure that it will get processed. The other item that we want to touch on is reviewing life insurance. Many people have annuities, CDs, old 401ks. We also have found that a number of clients have stocks that have just been sitting out there. Let's help take a look, maybe to simplify, maybe to consolidate. Doesn't mean you have to sell anything or change anything, but there are some benefits to coordinating and maybe consolidating. There is a COLA for Social Security this year, which is 2.5%. That goes into effect in January. Medicare open enrollment runs through December 7th. We have a free service that we help our clients shop Medicare. And if that's of interest, let us know, give us a call, and we can absolutely help you. We have seen more cybersecurity scams than ever. And frankly, as we move into the holiday season, it seems like it's more rampant now than ever. Please be careful. If you're not sure about something, financially speaking, call us. Don't reply to emails. Even if it seems legitimate, give us a call. Let's talk on the phone. And then the last item here is that you're going to see a new Schwab statement for your October statement. It's a new, fresh statement. You're going to have all the data you've always had, but it's nice, it's clean, and it has a little more information. We really like it, and just be on the lookout for that. If you have questions, please, at the bottom of the screen, type in questions. It looks like we already have a number of questions already typed in. We're going to do our very best to get to everyone's question, but please tell us what's on your mind. It's probably on someone else's mind as well. So on that note, let's jump into some questions. All right. So first question is, oh, this is a good one. Should we make any changes before the election or after the election? Adam, you want to take that one?
Yeah, so we will make any changes as needed when needed. Now, in this case, as Sam had mentioned earlier, our investment process is data-driven. So we really try to separate the politics from market fundamentals. We like to say profits over politics. So while some policies, of course, are better for growth than others, the market really is resilient, whether or not a Democrat or a Republican is in the White House. So again, profits over politics, and the short answer is no.
Okay, next question is, are you concerned about the significant increase in the federal deficit? Sam, you want to take that one?
Yeah, I'll take that one. The net interest that we are paying on our federal debt is 13% of the budget, which makes it the third largest line item that we have, right behind Social Security and Medicare. And with interest rates still being higher than they've been over the last 10 plus years, we're refinancing our debt actually at higher and higher rates as some of those bonds mature. So in the short term, I would say it is definitely concerning that things look like they are not trending in the right direction. But we don't think that it's going to have any impact in terms of how the government operates or any systems. But as we look at intermediate and long term, yes, there is going to need to be some really tough decisions on how we're going to navigate that going forward, particularly with the idea that our federal government runs a deficit every single year, which means we need to continue borrowing more and more. So, short answer is yes, this is definitely a problem, but there's really not a lot that we can do about it in the short term. And quite frankly, we don't really get the sense that there's many people in Washington that are very focused on getting this under control either at the moment.
Okay, thank you. All right, next question. Let's jump into that. Since the Federal Reserve cut interest rates, what do you think is going to happen with mortgage rates? Adam, you want to?
Yeah. So as we know, the Federal Reserve controls the federal funds rate. However, the 30-year mortgage rate is influenced by the market's expectations of future growth and inflation. So typically, Fed cuts lead to stronger growth, thus potentially pushing rates higher due to increased demand for mortgages. However, when we're sitting here next year, we think it's highly likely that mortgage rates will be lower by this time next year. So I know if you had questions on this, we do believe mortgage rates will be lower by this time next year. Reason for that is the Fed continues to lower rates. usually puts a downward pressure and helps lower mortgage rates. So with that, if you are interested in purchasing a home, we may be able to get you a substantial discount on your mortgage rate. So please let us know. Give us a call, give us an email, and we'll do our best to help.
Yeah, there was another question related to that regarding refinancing, purchasing a home when rates were much higher, and now that they're lower, what's the recommendation on refinancing? Again, give us a call. We can go into those kind of details and questions related. On that note, I'm gonna say thank you to everyone. There's obviously we didn't get to every single question. Please call us. Let's meet. Let's talk and go over some of those questions that didn't get answered on the webinar today. Give us a call, schedule a time for us to meet in person, over the phone, or Zoom. And we want to say thank you. We appreciate you all very much. Have a wonderful rest of your day.
Thank you.
Thank you.
Bye-bye.